It's Monday, let's talk money. Today we're going to be talking about home equity and home equity lines of credit, or HELOCs. First, let's establish what home equity is. Home equity is the portion of your home that you own outright. What you own outright is what you pay for out of pocket, as opposed to financing with a loan. For example, if you bought your home entirely with cash, or you have paid off your mortgage, you have 100% equity stake in your home. If you haven't paid off your mortgage, your home equity can be calculated by subtracting your mortgage balance from your home's current market value. So why is it important to establish home equity as a homeowner? If you want to upgrade your home with renovations or pay off higher priced debt, you can borrow against your home equity to do so. Home equity lines of credit, or HELOCs, are one of the most common ways to borrow against your home equity. A HELOC is exactly what it sounds like. It's a line of credit that is secured by the equity in your home. When you take out a HELOC, you first have a drop period, which varies but could be 5 or 10 years. This period works similarly to a credit card. You can borrow as little or as much as you need up to the approved credit limit. That approved credit limit, or the maximum amount you can borrow, is determined based on the equity you have in your home. In many cases, during the draw period, you only have to pay interest on what you've borrowed. It's best to confirm what the product terms state. After the draw period, the repayment period begins. The repayment period also varies, but often will be between 10 and 20 years. During this period, you can no longer borrow from your credit line, and you will have to make regular payments of the amount that you borrowed plus interest. These payments will be monthly, and the amount you'll have to pay each month will depend on how much you borrowed. So when is it good to use a HELOC? It's good for long-term projects or projects that have frequent costs that fluctuate. Think projects like home renovations, school tuition, or debt consolidation. These types of things are better suited for a HELOC because the interest rate is typically lower than a credit card. And it's important to note that the interest rates on HELOCs are adjustable, which means the rate can go up and down depending on how the market is doing. How do you know if a HELOC is right for you? Talk to one of our banking experts. Tell them your goals and they'll be able to direct you if a HELOC or another loan product is the best fit for what you want to accomplish. Like this video? Follow @Valley Bank for more tips.